Question 1. Legal and regulatory framework. Which of the following is true regarding the formation of a captive insurance company in Minnesota? A. Captive insurance companies must submit a detailed business plan along with an initial capitalization report to the Minnesota Department of Commerce for approval. B. The minimum required capitalization for a captive insurer in Minnesota is fixed at $5 million regardless of the type of business it insures. C. A Minnesota-based captive must appoint a board of directors comprising solely of non-resident individuals. D. Captives are not required to comply with any federal regulations, as they are entirely governed by state laws in Minnesota. Answer A. Explanation. In Minnesota, when forming a captive insurance company, a detailed business plan must be submitted to the Minnesota Department of Commerce, including an initial capitalization report. This ensures that the company has adequate financial backing and a well-thought-out operational plan. The state does not have a fixed minimum capitalization requirement like option B. Instead, the amount varies, depending on the type of captive. Furthermore, captives are governed by both state and federal regulations, contrary to option D, and the composition of the board of directors, option C, is not restricted to non-residents. Question 2. Financial aspects of captive insurance. Which of the following is the most likely reason why a Minnesota-based captive insurance company would choose to follow the statutory accounting principles (SAP) rather than the generally accepted accounting principles? GAAP-SAP is generally simpler and more cost-effective to maintain, which benefits smaller captives. B. Captive insurers in Minnesota are required by law to follow GAAP for external reporting purposes. C. SAP is intended for entities that do not need to hold reserves, which makes it ideal for captives. D. SAP aligns more closely with regulatory reporting requirements, making it easier for captives to comply with state insurance department guidelines. Answer D. Explanation. Statutory accounting principles (SAP) are used by captive insurers in Minnesota primarily because they are aligned with regulatory reporting requirements. This alignment allows captives to meet the specific requirements set by the Minnesota Department of Commerce. SAP is designed to be more conservative in recognizing liabilities and assets, ensuring that the insurer maintains adequate reserves to meet regulatory standards. While GAAP is commonly used for general financial reporting, SAP is mandatory for state-regulated insurance entities like captives. Option is incorrect because SAP is not necessarily simpler or cheaper to maintain, and option C is incorrect as captives are required to hold reserves, which SAP helps regulate. Question 3. Scenario-based question. Risk management and actuarial practices. Sarah is the owner of a small manufacturing company in Minnesota and is considering setting up a captive insurance company to handle her business's risks. She intends to insure against risks like property damage, workers' compensation, and product liability. As part of the feasibility study for her new captive, Sarah hires an actuary to help estimate the reserves required for each of these risks. The actuary provides a reserve recommendation, but Sarah is concerned that the reserves might be too high and impact the profitability of the business. Which of the following actions should Sarah take regarding the actuary's recommendation? A. Sarah should ignore the actuary's recommendation and set the reserves based solely on her past claims experience, as that will give a more accurate picture of future risk. B. Sarah should challenge the actuary's recommendations and ask for a low reserve amount to optimize profitability, as captives can adjust reserves based on their financial performance. C. Sarah should seek a second opinion from another actuary to validate the reserve estimation before making a decision, ensuring regulatory compliance and financial stability. D. Sarah should accept the actuary's reserve recommendation without question, as captives are not allowed to adjust their reserves once they are set. Answer C. Explanation. In this scenario, the best course of action for Sarah is to seek a second opinion from another actuary. This ensures that the reserve estimation is accurate and aligns with both the regulatory requirements and the financial needs of the captive. Reserves must be set to meet both the actuarial assessment of future liabilities and the requirements of the Minnesota Department of Commerce. The reserves cannot be adjusted solely for profitability reasons. Contrary to option B, while captives have flexibility, they still need to remain compliant with state regulations and be financially sound, which justifies seeking an independent review of the actuary's recommendations. Option is not advisable because relying only on past claims may not fully account for potential future liabilities, and option D is incorrect because reserves can be adjusted as needed, subject to regulatory guidelines. Question 4. Reinsurance in captive insurance. Which of the following is true regarding reinsurance agreements for a Minnesota-based captive insurance company? A. A captive insurer can only use reinsurance for catastrophic risks and not for routine operational risks. B. Reinsurance agreements must always be proportional, meaning that a fixed percentage of premiums and losses must be shared with the reinsurer. C. The Minnesota Department of Commerce mandates that all reinsurance contracts must be reviewed by the state before they are executed. D. Captives are prohibited from using fronting arrangements in reinsurance contracts under Minnesota law. Answer: C. Explanation. In Minnesota, the Minnesota Department of Commerce requires reinsurance agreements to be reviewed by the state before they are executed. This ensures that the agreements meet regulatory standards and do not expose the captive insurer to unnecessary risk. While captives often use reinsurance for a variety of risks, including catastrophic and operational risks, contrary to option A, reinsurance agreements are not always proportional. Option B, captives can also use fronting arrangements. Option D, as a means of obtaining reinsurance, and the state does not prohibit this practice. Question 5. Corporate governance and ethical considerations. Which of the following is a key responsibility of the board of directors of a captive insurance company in Minnesota? A. Ensuring that the captive's premiums are set at the highest possible rates to maximize profits. B. Overseeing the captive's compliance with regulatory requirements, including those set by the Minnesota Department of Commerce. C. Managing the day-to-day operations of the captive, including claims handling and underwriting decisions. D. Ensuring that the captive does not offer coverage to high-risk industries such as construction or healthcare. Answer: B. Explanation. The board of directors of a Minnesota-based captive insurance company is primarily responsible for overseeing the company's compliance with regulatory requirements, including those set by the Minnesota Department of Commerce. They are not responsible for setting the highest possible premiums to maximize profits. Option A. Nor are they involved in managing day-to-day operations like claims handling or underwriting. Option C, which are typically handled by the captive's management team. While captives may choose which industries to insure, there is no blanket prohibition against covering high-risk industries. Option D. The board's focus should be on governance and regulatory compliance. Question 6. Risk management and actuarial practices. Which of the following is the primary role of actuaries in captive insurance companies in Minnesota? A. Actuaries are responsible for creating marketing strategies to attract policyholders to the captive. B. Actuaries help estimate the appropriate premium amounts and calculate the reserves needed to cover future claims. C. Actuaries are responsible for setting the rules and regulations governing captive insurance companies. D. Actuaries handle the legal and regulatory documentation required to form a captive insurance company. Answer: B. Explanation. The primary role of actuaries in captive insurance companies is to help estimate the appropriate premium amounts and calculate the reserves needed to cover future claims. They use statistical models and actuarial methods to assess risk and ensure that the captive has enough financial resources to meet its obligations. The actuaries are not involved in marketing. Option A. Regulatory rulemaking. Option C. Or handling legal documentation. Option D, which are typically the responsibilities of other professionals within the captive's management or legal team. Question 7. Insurance fundamentals for captives. Which of the following is a key consideration when designing insurance policies for a Minnesota-based captive insurance company? A. Policies must be standardized across all policyholders with no customization allowed. B. Policy design should include tailored coverage that aligns with the unique risks of the insured business or industry. C. Policy terms must always include the same premium rates for all policyholders regardless of their specific risk profiles. D. Policy design must exclude any coverage for liabilities arising from environmental risks or cyber attacks. Answer: B. Explanation. When designing insurance policies for a Minnesota-based captive, it is essential to tailor the coverage to the specific risks of the insured business or industry. Captive insurance allows for customized policies that reflect the unique needs of the business, which is the primary advantage of using a captive. Standardized policies, option A, or rigid premium rates, option C, are not suitable as they fail to account for varying risk exposures. Additionally, captives are not restricted from providing coverage for environmental risks or cyber attacks, option D, especially given the increasing importance of these risks in modern business operations. Question 8. Emerging trends and innovations. Which of the following emerging trends is most likely to affect the future of captive insurance companies? A. The increasing reliance on traditional reinsurance markets, which reduces the need for captives. B. The growth of micro-captives and cell captives, which allows smaller companies to benefit from captive insurance. C. A decline in the use of technology and insurtech solutions in captive management. D. The reduction of environmental, social, and governance-esque factors in decision-making by captive insurers. Answer: B. Explanation. One of the most significant emerging trends affecting the future of captive insurance companies is the growth of micro-captives and cell captives. These structures allow smaller businesses to access the benefits of captive insurance, providing them with a more affordable and flexible way to manage their risks. The increased use of technology and insurtech, option C, is actually enhancing captive management, and ESG factors, option D, are increasingly being integrated into decision-making. Captives are not reducing their use of these factors, but rather adopting them to stay relevant in an evolving risk landscape. Option is incorrect because captives are being used in tandem with traditional reinsurance, not as a replacement. Question 9. Dispute resolution and legal challenges. Which of the following is the most appropriate method of resolving disputes between a Minnesota-based captive insurer and a policyholder regarding a claim settlement? A. The Minnesota Department of Commerce will automatically intervene and make a binding decision. B. The captive insurer and policyholder should attempt to resolve the dispute through informal negotiations or mediation before considering legal action. C. The policyholder has the right to file a lawsuit against the captive insurer in federal court immediately. D. Disputes must be resolved solely through arbitration, as courts are not permitted to intervene in captive insurance claims. Answer: B. Explanation. The most appropriate method for resolving disputes between a Minnesota-based captive insurer and a policyholder is through formal negotiations or mediation. Mediation is often encouraged as a first step in resolving disputes, as it can help both parties reach a resolution without the need for litigation, while legal action, option C, or arbitration, option D, can be used if mediation fails. They are not the first options. The Minnesota Department of Commerce, option A, does not automatically intervene in individual disputes, although it may be involved if there is a regulatory issue. Question 10. Formation and structure of captive insurance companies. When forming a captive insurance company in Minnesota, which of the following is a critical factor to consider when selecting the domicile for the captive? A. The domicile must always be located in Minnesota, as out-of-state captives are not permitted. B. The domicile should be selected based on the regulatory environment, tax benefits, and ease of compliance with state laws. C. The domicile should be chosen based solely on the availability of cheaper office space and lower operational costs. D. The domicile should be selected based on the reputation of the local reinsurance market, even if it contradicts the business's operational needs. Answer: B. Explanation. When selecting the domicile for a captive insurance company, the most important factors to consider are the regulatory environment, tax benefits, and the ease of compliance with state laws. These elements ensure that the captive will operate efficiently and meet all regulatory requirements, while operational costs, option C, and reinsurance markets, option D, may influence the decision. They should not outweigh regulatory and legal considerations. Option is incorrect, as Minnesota-based captives can sometimes benefit from choosing other domiciles based on their specific needs. Question 11. Tax considerations for captives. Which of the following tax-related requirements must a Minnesota-based captive insurance company meet to qualify as an insurance company under IRS guidelines? A. The captive must primarily insure risks of unrelated parties. B. The captive must issue policies that are under and based on a shared risk pool. C. The captive must maintain a minimum level of capital and surplus as prescribed by the state of Minnesota. D. The captive must be organized as a mutual insurance company. Answer A. Explanation. For tax purposes, a captive insurance company must primarily insure risks of unrelated parties in order to qualify as an insurance company under IRS guidelines. If the captive only insures the risks of its parent or affiliated companies, it may not qualify for tax benefits. The IRS requires that the company operate as an insurance company, including meeting specific requirements related to risk pooling, capital requirements, and underwriting. Minnesota law may set capital and surplus requirements, option C, but it is the IRS guidelines that emphasize unrelated party insurance. Question 12. Financial reporting and solvency. Which of the following is required for a Minnesota-based captive insurance company to demonstrate financial solvency? A. The captive must submit an annual audit report conducted by an independent certified public accountant. B. The captive is not required to submit financial reports if it does not write any claims. C. The captive must maintain a statutory surplus of at least $500 million to cover potential losses. D. The captive must only submit quarterly financial statements to the Minnesota Department of Commerce. Answer A. Explanation. To demonstrate financial solvency, Minnesota-based captive insurance companies must submit an annual audit report conducted by an independent certified public accountant. This audit ensures that the captive has sufficient financial resources to cover its liabilities. The state may also require other reports, but there is no specific minimum surplus requirement of $500 million. Option C. Captives must submit annual reports and not just quarterly financial statements. Option D. Question 13. Risk management practices in captives. Which of the following is a primary reason why businesses form a captive insurance company in Minnesota? A. To reduce the amount of claims they pay out to their policyholders. B. To gain more control over their insurance premiums and claim processes. C. To eliminate all external insurance needs and avoid paying premiums to third-party insurers. D. To increase the size of their insurance portfolio and enhance profits by selling policies to unrelated businesses. Answer B. Explanation. One of the primary reasons businesses form a captive insurance company is to gain more control over their insurance premiums and claim processes. The captives allow companies to better manage risk, tailor coverage to their specific needs, and keep premiums within the organization. While captives may reduce external insurance costs, they do not entirely eliminate the need for third-party insurers. Option C. Or involve selling policies to unrelated businesses. Option D. The goal is not to increase profits from selling policies, but to manage risk more effectively. Question 14. Risk pooling in group captives. What is a key benefit of a group captive insurance company in Minnesota? A. The ability to pool risks with other businesses, thereby reducing the cost of coverage for all participants. B. The ability to provide a standard insurance policy to all participants, regardless of their individual needs. C. The ability to set premiums independently for each participant, based solely on their individual risk profile. D. The ability to insure only one business while pooling risks with unrelated third parties. Answer A. Explanation. A key benefit of a group captive insurance company is the ability to pool risks with other businesses, thereby reducing the cost of coverage for all participants. Group captives allow multiple businesses to share the risk and financial responsibility, often leading to low premiums and more customized insurance coverage. While group captives may still offer tailored policies, the risk pooling aspect is a central feature. Premiums are not set solely based on individual profiles in group captives. Option C, nor do they insure only one business. Option D. Question 15. Regulatory oversight in Minnesota. Which state agency is responsible for overseeing captive insurance companies in Minnesota? A. The Minnesota Department of Commerce. B. The Minnesota Department of Insurance and Financial Services. C. The Minnesota State Legislature. D. The Minnesota Department of Revenue. Answer A. Explanation. In Minnesota, the Minnesota Department of Commerce is responsible for overseeing captive insurance companies. This agency regulates the formation and operations of captives, ensuring they comply with state laws and maintaining financial solvency. The Department of Insurance and Financial Services, Option B, is not the overseeing agency in Minnesota, and the state legislature, Option C, and Department of Revenue, Option D, do not have direct regulatory responsibilities over captives. Question 16. Formation and capitalization of captives. What is the minimum capital requirement for a captive insurance company in Minnesota? A. $1 million for single-parent captives. B. $500,000 for group captives. C. $1 million for single-parent captives and $500,000 for group captives. D. There is no minimum capital requirement, as captives are not regulated by the state. Answer C. Explanation. In Minnesota, the minimum capital requirement for a captive insurance company is $1 million for single-parent captives and $500,000 for group captives. These capital requirements ensure that captives have enough financial resources to meet their obligations and maintain solvency. The state does regulate captives, and the minimum capital thresholds help protect policyholders and maintain the financial stability of captives. Question 17. Claims handling in captives. Which of the following is most likely a responsibility of the claims department within a Minnesota-based captive insurance company? A. To set the premium rates for all policies issued by the captive. B. To determine the legal and regulatory framework for insurance policy formation. C. To assess, process, and settle claims made by policyholders. D. To oversee the selection of fronting insurers for reinsurance arrangements. Answer: C. Explanation. The claims department within a Minnesota-based captive insurance company is primarily responsible for assessing, processing, and settling claims made by policyholders. While the claims department may work with other departments, including underwriting and risk management, they are not typically involved in setting premium rates, option A, determining legal frameworks, option B, or selecting fronting insurers, option D, which are tasks handled by other areas of the company. Question 18. Reinsurance and captive insurers. What is one advantage of using reinsurance for a Minnesota-based captive insurance company? A. Reinsurance allows the captive to share the financial burden of large claims with another insurer, reducing the risk of insolvency. B. Reinsurance guarantees that the captive will never face claims larger than it can handle. C. Reinsurance eliminates the need for the captive to maintain reserves for future claims. D. Reinsurance increases the profit margin of the captive by attracting more policyholders. Answer A. Explanation. One key advantage of using reinsurance for a Minnesota-based captive insurance company is that it allows the captive to share the financial burden of large claims with another insurer, thereby reducing the risk of insolvency. Reinsurance helps the captive manage catastrophic risks and smooth out fluctuations in claims. It does not guarantee that the captive will never face large claims, option B, eliminate the need for reserves, option C, or necessarily increase profits, option D. The primary benefit is managing risk. Question 19. Exit strategy for captives. Which of the following is a potential exit strategy for a Minnesota-based captive insurance company that is no longer needed by the parent organization? A. The captive can be sold to an unrelated third-party insurer. B. The captive can be dissolved and its assets distributed to the parent company. C. The captive can merge with another unrelated captive. D. The captive can be liquidated by the Minnesota Department of Commerce. Answer: B. Explanation. If a Minnesota-based captive insurance company is no longer needed by the parent organization, the captive can be dissolved and its assets distributed to the parent company. This process typically involves ensuring that all liabilities and obligations are settled before dissolution. The option to sell the captive to an unrelated third-party insurer, option A, is not a typical exit strategy, nor is merging with another unrelated captive, option C, liquidation by the Minnesota Department of Commerce, option D, occurs only in cases of insolvency or regulatory failure, not voluntary exit. Question 20. Emerging risk management techniques in captives. Which emerging risk is increasingly being covered by Minnesota-based captive insurance companies? A. Risks related to climate change and environmental disasters. B. Political risks associated with international operations. C. Cybersecurity risks and data breaches. D. Risks related to employee healthcare and benefits. Answer: C. Explanation. One emerging risk that is increasingly being covered by Minnesota-based captive insurance companies is cybersecurity risks and data breaches. As businesses become more reliant on technology and digital infrastructure, the need to protect against cyber attacks and data security breaches has grown significantly, while climate change, political risks, and employee healthcare are also areas of concern. Cybersecurity is an area where captives have seen growing interest and activity in recent years. Question 21. Minnesota captive insurance taxation. Which of the following tax-related benefits may a Minnesota-based captive insurance company enjoy? A. Exemption from state income tax on premiums paid to the captive. B. Deductibility of insurance premiums paid to the captive by the parent company for federal tax purposes. C. No state-level taxation even on claims payouts. D. A tax exemption on all reinsurance premiums received by the captive. Answer: B. Explanation. A Minnesota-based captive insurance company may provide tax benefits to the parent company in the form of deductible insurance premiums paid to the captive for federal tax purposes. However, captives are not typically exempt from state-level taxation on premiums, claims payouts, or reinsurance premiums. Federal tax law allows for the deductibility of premiums under certain circumstances, but this is not the case for all types of tax or claims-related situations. Question 22. Capital requirements for captives. What is the purpose of the capital requirement for a captive insurance company in Minnesota? A. To ensure the company has enough financial resources to pay its claims. B. To allow the company to collect premiums from unrelated third parties. C. To comply with state insurance laws for regular insurance companies. D. To increase the profitability of the captive by lowering operational costs. Answer A. Explanation. The capital requirement for a captive insurance company is designed to ensure the company has sufficient financial resources to cover potential claims. These requirements are part of the regulatory framework intended to maintain solvency and protect policyholders. The capital requirement does not specifically allow the company to collect premiums from unrelated third parties, option B, nor is it intended solely for compliance with broader state insurance laws, option C, or to increase profitability, option D. Question 23. Ownership structure of captive insurers. What is a common ownership structure for a single-parent captive insurance company in Minnesota? A. It is owned by a single-parent company that insures only the risks of that company. B. It is jointly owned by multiple unrelated companies to pool risks. C. It is owned by a third-party insurer that manages the risks for multiple entities. D. It is owned by the state of Minnesota and provides coverage for local businesses. Answer A. Explanation. A single-parent captive insurance company in Minnesota is typically owned by one parent company which insures the risks of that company. This structure allows the parent company to manage its own risk and insurance needs. It does not involve joint ownership by multiple unrelated companies, option B, a third-party insurer, option C, or state ownership, option D. The single-parent model is common for businesses that want more control over their insurance policies. Question 24. Fronting arrangements in captives. What is a fronting arrangement in the context of a Minnesota-based captive insurance company? A fronting arrangement involves a third-party insurer issuing policies on behalf of the captive. B. A fronting arrangement allows the captive to write insurance policies for unrelated businesses. C. A fronting arrangement eliminates the need for the captive to comply with state insurance regulations. D. A fronting arrangement is a method used by captives to reduce the amount of capital they need to maintain. Answer A. Explanation. A fronting arrangement involves a third-party insurer issuing policies on behalf of the captive. This allows the captive to provide coverage to its parent company or other entities while still complying with state insurance regulations. The fronting insurer typically takes on the regulatory responsibilities, but the risk is then transferred to the captive through reinsurance. Fronting does not eliminate the need for regulatory compliance, option C, or reduce the capital requirements, option D, and it does not allow captives to write policies for unrelated businesses, option B. Question 25. Captive insurance for employee benefits. Which of the following is a potential use of a captive insurance company in Minnesota? A. To provide employee health benefits and other welfare programs. B. To insure all employees directly and cover their personal insurance needs. C. To offer life insurance policies to third-party individuals. D. To provide property and casualty coverage to unrelated businesses. Answer A. Explanation. Captive insurance companies can be used to provide employee health benefits and other welfare programs. This is often done through employee benefit captives, which help businesses manage the cost of employee health, disability, and life insurance. Captives are not typically used to provide life insurance to third-party individuals, option C, or to insure unrelated businesses, option D. They may offer coverage to employees, but not directly cover their personal insurance needs, option B. Question 26. Minnesota Captive Insurance Regulations. Which of the following would a Minnesota-based captive insurance company be required to do under state regulations? A. Maintain sufficient reserves to cover incurred but not reported IBNR claims. B. Allow any policyholder to request a refund of premiums at any time. C. Issue policies only to unrelated businesses. D. Limit its insurance business to the state of Minnesota. Answer A. Explanation. Under Minnesota's regulations, a captive insurance company is required to maintain sufficient reserves to cover incurred but not reported IBNR claims. This ensures the company has enough funds to cover claims that have occurred but have not yet been reported. Captives are not restricted to issuing policies only to unrelated businesses, option C, and they are not required to limit their insurance business to Minnesota, option D. Refunds of premiums are not typically required or guaranteed by state law, option B. Question 27. Captive insurance governance. Who typically has the final authority in a Minnesota-based captive insurance company when making decisions regarding claims settlements? A. The board of directors of the captive. B. The policyholders of the captive. C. The Minnesota Department of Commerce. D. The fronting insurer. Answer A. Explanation. The final authority in a Minnesota-based captive insurance company regarding claims settlements typically lies with the board of directors of the captive. The board is responsible for overseeing the company's operations and ensuring that claims are handled appropriately, while the Minnesota Department of Commerce regulates the captive, option C, and fronting insurers may have a role in claims administration, option D. The board of directors is responsible for the decision-making process. Question 28. Reinsurance requirements in captives. Why would a Minnesota-based captive insurance company consider purchasing reinsurance? A. To reduce the financial risk associated with large claims. B. To avoid paying claims to policyholders. C. To avoid state-level regulation of its operations. D. To sell additional policies to third-party businesses. Answer A. Explanation. A Minnesota-based captive insurance company may purchase reinsurance to reduce the financial risk associated with large claims. Reinsurance allows the captive to share the burden of catastrophic claims with other insurers, thereby reducing its potential financial exposure. Captives do not purchase reinsurance to avoid paying claims to policyholders, option B, or to avoid state-level regulation, option C. The purpose is to manage risk, not to sell policies to unrelated businesses, option D. Question 29. Minnesota Captive Insurance Reporting. What is one common report that a Minnesota-based captive insurance company must submit to the Minnesota Department of Commerce? A. An annual financial statement that is audited by an independent CPA. B. A monthly list of claims paid and incurred during the month. C. A quarterly report of all premiums collected from policyholders. D. A quarterly listing of all insurance policies sold by the captive. Answer A. Explanation. One common report that a Minnesota-based captive insurance company must submit to the Minnesota Department of Commerce is an annual financial statement that is audited by an independent certified public accountant (EPA). This audit ensures that the captive remains solvent and compliant with state regulations. While captives may need to submit other reports as well, the annual audited financial statement is a primary regulatory requirement. Question 30. Captive insurance risk management. Which of the following best describes a risk management strategy that a Minnesota-based captive insurance company might use? A. Implementing risk retention strategies to assume more risks in exchange for lower premiums. B. Developing an employee wellness program to prevent insurance claims. C. Selling insurance policies to third-party businesses to expand the risk pool. D. Using a reinsurance arrangement to transfer risks associated with catastrophic events. Answer D. Explanation. One of the key risk management strategies that a Minnesota-based captive insurance company might use is a reinsurance arrangement to transfer risks associated with catastrophic events. Reinsurance helps captives manage large losses and reduces their financial exposure. While captives may use risk retention strategies, option A, and focus on employee wellness programs, option B, they do not typically sell policies to third-party businesses, option C, in order to expand their risk pool.